in Washington State recently passed a ruling back in July of this year that's going to give benefit enhancements to the LEOFF plan members. So if you're a law enforcement officer or a firefighter, this benefit is going to affect you, whether you're a new hire, have been working in the system for a long time, or have already retired. And it doesn't matter if you're on plan 1 or plan 2, this new benefit enhancement affects everybody. So recently, DRS sent out letters to all of the members affected by it, giving you benefit options and saying that you need to make an election by January 5th. Otherwise, there's going to do the default option for you. So the point of this video is to go through all the different scenarios of how this will affect you. We're going to go over the tax implications of the different choices so you can make a well-informed decision. All right, so what basically happened is DRS was reviewing the LEOFF pension system. They had excess funds and decided to distribute to the members. So what they did is they are going to do a one-time lump sum benefit to members that are either already retired or who have been currently employed before February of 2021. So they're basically offering you guys a lump sum benefit that's equal to $100 for every service credit month that you have in the system. For some people, you're going to get a benefit enhancement that gives you a higher benefit or pension in the future. So for the LEOFF Plan 1 members, your only option is to take the lump sum, right? So you're either going to get a lump sum that's $100 for every service credit month that you have. It's just a one-time payment, and then that's it. You're not eligible for any enhanced, pension benefits, and you're also not eligible to purchase the LEOFF annuity with these funds. So you have to take the money as a lump sum. That being said, you can take it in cash, or you can roll over into another retirement plan. If you roll over into a retirement plan, you avoid paying taxes on it today. If you take it in cash, you will be taxed on it. They're going to hold 20% for taxes, but you're still going to be taxed on the entire thing. So for LEOFF Plan 1 members, that's kind of your only option and what you need to know about it. For LEOFF Plan 2 members, there's a lot more coming. So for anybody, regardless if you're Plan 1 or Plan 2, and you retired with a line of duty disability, you're going to get the greater of either the lump sum benefit, which is $100 per service credit month that you worked, or $20,000, whichever one's higher. So if you work, say, for 5 years in the system before going disabled, that's 60 service credit months. Obviously, the $20,000 is going to be higher than that. You're going to end up with the $20,000. So whatever one's higher is what you're going to get. Now, for people that have already retired, either on or before February 1st of 2021, your only option is the lump sum payout, just like Plan 1 members. So you are going to be eligible to take a one-time lump sum, and this lump sum does not affect your pension in any way. It doesn't reduce it or stop or anything like that. This is just an excess funds that they're giving you from the pension fund. So it doesn't affect your current pension. That's still going to continue for the rest of your life. This is just a one-time lump sum payment. Now, remember, you get $100 for every service credit month that you have. In your letter that you receive from DRS, they had that calculated ready for you. So it makes it really easy to see what you're entitled to. Now, with this lump sum benefit, you have the option to, again, take it in cash if you want to. You can roll over into your retirement account, or if you have more than $20,000 as a lump sum, you have the option to purchase an annuity from DRS. This is the LEOFF Plan 2 annuity. It's basically the same thing if you went ahead and bought service credits with the money. It's the same kind of payout factor. So those are the three options that you have with this money. All right, so if you go ahead and say, hey, I'm just going to take it in cash, just give me it all, they're going to hold 20% automatically. It's just an automatic 20% withholding. They'll send you the rest. You can spend it as you see fit. Depending on your tax status, that 20% may or may not be enough to actually cover all the taxes. So you want to make sure that 20% is going to be enough or sufficient for your current income situation. Keep in mind, though, that because this is a lump sum distribution, that entire amount, even if they're holding taxes, the entire amount counts as part of your taxable income. So if you're currently retired and on Medicare and Social Security, this is definitely going to impact those other benefits. So because Social Security bases their taxable portion on something called provisional income, when you have a future cash like this that's taxable, it's going to raise your threshold of provisional income, which means more of your Social Security is going to be subject to taxes. So you may see a net decrease in your Social Security, at least for 2023. These payments come out by the end of January of 2023. So you're going to see that hit you down the road. And because the payments are in January of this year, by the time the end of next year rolls around, many people are going to kind of forget that they got this money, and it might throw off their tax planning situation. So you want to make sure that if you are going to take the lump sum benefit, you're prepared for the impact it's going to have on your Social Security benefits, but also prepare for your Medicare benefits to be impacted. Medicare has income thresholds. You cross that threshold by just $1, you and your spouse now have to pay higher premiums for the entire year. So you want to make sure you're not going to cross the threshold and end up paying, a couple $100 more per month for Medicare benefits just to get this lump sum benefit. So if you want to avoid that, what you could do is roll it into a retirement account. It can be an IRA, it could be your current DCP or any other retirement account that you have out there. The money that moves in there is pre-tax, so there's no taxes due right now. If you're already retired and past the required ages, you can also get access to the money anytime you want to. So it's not like you're locking the money away forever. If you only need a partial distribution for some bills or whatever you need to pay off, you can still do that through the IRA distributions. So the other option you have is just to roll it over and invest it. Option 3 is purchasing the LEOFF annuity. So this is an income annuity. Essentially, this money is going to help generate another guaranteed source of income. They're actually going to lump it into with your current LEOFF 2 pension payment. So if you purchase the annuity, they'll take your current LEOFF 2 payment, whatever the dollar value is of the LEOFF annuity, they lump it together. So you still get one check from the state, but it'd be slightly higher depending on how much money you put into the annuity and what the payout factors are. And it really depends on how old you are and how much money is going in there, so what you're going to get out of it. As far as if it's a good deal or not, most times these DRS annuities actually pay really competitive, especially in today's rising environment rates. The DRS annuities have some of the highest income planning options out there. Plus, they have cost of adjustments built in that are the exact same rules as your current LEOFF 2 benefit. So you're going to get the 0 to 3% COLA on these annuity payments every single year. As far as which option to take, my perspective is if you're in need of income, you're like short on income, you want more guaranteed income, the LEOFF annuity may not be a bad idea. Otherwise, you're probably going to be better off just moving into an IRA account until you need it. If you are absolutely short on cash and you need the money right now, then yes, you can consider taking the lump sum. Just be prepared if it's going to affect your Social Security or your Medicare before doing so. Because once that money comes out, you can't reverse it essentially. So you want to make sure you know full well of what the tax implications are before taking the lump sum. Now, for the current active LEOFF employees, you're going to have the option to choose to either take the lump sum or get an enhanced pension benefit. So the enhanced pension benefit is they're going to give you an extra 0.5% for years 16 through 25 that you've worked. So basically it equates out to an extra 5%. So the old pension system was 2% for every single year, regardless of how many years you put in the system. This new one is you still get 2% for every single year you work. That's for years 1 through 15. But years 16 through 25 that you're working, you're actually going to get 2.5%. Any years that are past 25, it's still back to 2%. So all in all it's going to do is increase the benefit for those that actually have more than 15 years in the system. So if you're someone that is in that range, you have the option to choose, do you want the lump sum benefit or do you want the enhanced? Whatever you choose, it's irrevocable and you're stuck with that decision for the rest of your life. Now, as far as which one you should choose, I'll come back to that in a little bit. So moving on to the new hire. So anyone hired after February 1st of 2021, you guys are automatically going to be in the new enhanced LEOFF 2 program or benefit calculation. So you're not going to have a choice essentially of what to take. You're just going to get a higher pension. So nothing you have to really worry about. And that's just the new benefit that you're entitled to. All right, now let's go back to the earlier question. Should you take the lump sum benefit or should you go with the enhanced benefit option? So I'm going to bring out my whiteboard, kind of walk you through my train of thought of how I would calculate it so you can make a better informed decision when the time comes. Remember, for the current employees on the LEOFF system, this is not a decision you have to make right now. It's something that you're going to have to elect upon your retirement, right? But it's nice to know ahead of time what your options are and which one's going to be best for you. Okay, so this is how I would calculate if it's better to take the lump sum or doing the enhanced benefit. So lump sum is pretty easy to calculate. It's just $100 times the number of service credit months that you have. So let's say you have 25 years in the system. So you say 25 years times 12 months, it's 300 months, right? It's going to give you a total of $30,000. Right, so that's going to be your lump sum option, this 30 grand right here, right? The benefit enhancement, right? They pay you 2% for years 1 through 15. So your first 15 years. So that's 2% times 15. All right, that's going to be equivalent to 30%. And then your years 16 to 25 is paid at 2.5%. So you're going to take 2.5 times the additional 10 years that you have. That's going to be equivalent to 25%. So we're just going to add these two up. You get 55% of the benefit. So now it's 55% of what? Of your average top 5 years of service. Now let's just say your average top 5 years is going to be $80,000. Right? Might be more, might be less. We'll go with 80. So all you gotta do is take your average salary, 80,000, times your 55%. You're gonna get 44 grand. Right? That's your pension benefit. Right? So that's enhanced. So you can either take the 30 grand or you get the 44,000. Right? So that's the enhanced benefit. The unenhanced version, right? So what are we going to compare it to? It's just a straight 2%, right? So it's just 2% times your 25 years of service, you get 50%, right? It's 50%, so it's half of whatever your benefit is. So it's going to be 40,000, right? So if you took the lump sum, you're going to have $40,000 a year for the rest of your life, plus a lump sum of 30 grand. If you said, don't give me a lump sum, just give me the enhanced benefit, you get this 44,000 right here. So which one's better? If you're looking for kind of break even on this, all you do is take the difference here, this $4,000 difference, and say, how long is it going to take $4,000 extra to make up this 30 grand? Right? So you just take your 30,000 divided by the 4,000, you're going to get 7.5 years. So that's your break even. So it takes you 7.5 years before you're going to start making more money than you initially got in the first place if you were to take the lump sum benefit, right? So it's being that the full retirement age for LEOFF employees is age 53, 7.5 years puts you a little over age 60. Definitely doable and well within most people's expected lifespan. So taking the enhanced benefit over the lump sum, you break even in 7.5 years, you're in your 60s, you still got a lot of life ahead of you, hopefully. So you're probably going to end up making more money this way, right? So if you're looking for what's the biggest bang for my buck, what's going to give me the most money, and what's going to be best for me or even my spouse in the long run, more than likely for most people, it's going to be this new enhanced benefit option, right? All right, so I hope you found this video helpful. If you can do me a favor, if you found value in this video, just make sure you hit the like button and share it with a friend. Any kind of law enforcement officer or firefighter is going to go through the situation right now and has to make a decision before January 5th. Otherwise, they're just going to get a check in the mail and it could potentially devastate their taxes for 2023. So do me a favor, share this with anyone you know that could be affected by it. I'll see you guys next week. Remember that your future depends on what you do today.